Stay informed on earnings trends and analysis in Zacks Earnings Outlook.
Let's see how the second quarter earnings season is shaping up, shall we? With our research director, Shiraz Mian, who's right here alongside of me. So it looks like Q2 is easily going to top Q1 as far as earnings growth, right?
Not so soon. So
Really?
we're almost there. We were 24 plus percentage point in Q1. We are slowly inching towards that. In a little bit, I'll show a slide which shows how Q1 earnings growth was, how Q2 is shaping up to be. So we're right there. Most likely we'll get there, perhaps a notch above that level, but we're not there yet.
So why are you hesitant? Do you see things, red lights?
There's no red, but we actually discussed this last week when the blended growth rate for Q2 was much lower relative to what it is now. We have reached close to 23% now, and it should be moving up there. But the question is whether the growth is above the Q1 level already, and the answer for that is no.
All right.
Will eventually get there? Yes, it'll get there.
Okay, so you kind of gave me both sides of that. So we could, it's realistic to think we could top Q1.
Absolutely.
All right. Let's recap the scorecard. Let's see what's in so far.
Sure. So, including all of this morning's results, and this is July 26th we are talking about,
Right.
217 S&P 500 companies have reported results already. Earnings are up 21.8% for these companies that have reported. Revenues are up 8.8%. 81.6% are beating EPS estimates. 72.8% are beating revenue estimates. The comparison charts that we are showing on this slide is comparing the growth rate from these 217 index members to what we had seen from the same companies in Q1, in the 4-quarter average and the 12-quarter average, and we'll do the same for the beat percentages. How the beats, earnings and revenue beats are tracking relative to historical periods. And as folks can see here, it's a very positive comparison. Growth relative to Q1 is about even. But relative to historical periods, the 4-quarter average, the 12-quarter average, significant improvements. Same with beats. A bigger proportion of companies is beating EPS and revenue estimates compared to historical periods.
Yeah, beats have been strong. Future guidance has been strong
That's
as
true.
well. So what does all that say about Q3 and Q4?
So this gives the market greater confidence on expectations for the second half of the year. And there was one of the elements we were, I personally was really watchful of, and I still am. The revisions trend ahead of the start of the Q2 earnings season wasn't as positive and impressive relative to what we had seen ahead of the start of the Q1 earnings season. And you would recall that ahead of the start of the Q1 earnings season, we had a big tax cut, and that prompted a whole bunch of adjustments to estimates. None of that obviously was there ahead of the June quarter results. So that gave us some concern and doubt about expectations for the second half of the year. These positive beats, the favorable guidance trend that you're referring to is helping Q3 and Q4 estimates hold up a lot better and give us more confidence in the overall earnings picture.
What's going on with tech? Do we have some issues there?
Very strong numbers, though some of the headline players of Facebook, the Netflix, they have had numbers that nobody really liked, and there were violent reactions to it. I have a slide that gives the lay of the land, so to say. So we still have Apple still to come, which is like a big player in the space, but about 60% of the tech sector's market cap in the S&P 500 has already reported results. And 34.7% is the year-over-year earnings growth For these companies that have reported, 11.8% is the revenue growth, 87% are beating EPS estimates, and 82.6% are beating revenue estimates. This is very strong showing relative to what we have seen from these same guys in prior periods. Just a brief comment on the Facebook and Netflix, which probably was the reason why you asked the question of what's going on with the tech space. I think those guys, those companies, they live and die by the sword. So they don't, their valuations and their trading behavior in the market doesn't reflect what one would call as normal expectations. So even when there is a shred of doubt about the growth momentum that everybody expects them to show, then that's what you have the big sell-off that you see in those companies. And the momentum works in the positive direction, and it doesn't take long for the momentum to switch direction. So that's what's happening. Overall, tech sector results are very good.
Do I understand correctly that the energy sector earnings are another standout, maybe expected to more than double from the year-ago level?
Absolutely, yeah. And a big reason for that is what's happening with oil prices. So oil prices are up significantly from this time last year. We have Exxon and Chevron coming out with the results tomorrow, which will crystallize what the final numbers for the sector should be, but they would at least be double what we had seen from the same period last year. We shouldn't assume that the strong earnings momentum we are talking about, the index as a whole, is primarily because of energy. Energy is a positive contributor to the overall growth, but growth would be really strong even on an ex-energy basis. Energy no longer has the weightage in the index to move the needle as much as it used to back in the day.
When do you expect this U.S. trade situation with the major trading partners and all of the news surrounding that to begin to manifest itself in the earnings results?
You know, that's a great question. There's no clear answer to that. The discussions at this stage are primarily on the qualitative side. I would expect that in the coming weeks and months, as some of these actions take concrete shapes and companies and industries start factoring in the impacts of levies here and abroad, that'll start showing up in estimates. At this stage, it's a qualitative negative. It's not a tangible, concrete negative in terms of showing up in estimates. We know it will be negative for estimates. How much and when it starts showing up, that we don't know.
So bottom line, are all of these good earnings results going to move the market higher going forward, or are the results already baked in?
So what is baked in, I have a slide I want to share with viewers. The orange color, the 23.4%, is the blended growth rate for Q2 as of today. And that's the companies that have reported versus estimates for the still to come. And that was the reason why I was a little hesitant when you asked me if Q2 will overtake Q1.
Yeah.
You will see it's almost there. And perhaps by the end of the reporting season, we would have crossed it, but not today.
Right.
So the second half, 19.3% earnings growth in Q3, 16.6% earnings growth in the last quarter of the year. These estimates have held up very well over the past few weeks as these companies have been reporting results. So this is what is priced in. And this is a very positive backdrop for the market. I would suspect that if these estimates were coming down, that will be a big negative for the market.
Sure.
So net, it's a good, reassuring environment for stocks as it's grappling with these other uncertainties, the trade issue that you discussed earlier, the Fed and the interest rate uncertainty. The one thing going for stocks is this earnings picture, and that's a net positive.
Okay, I'm sure we'll check back with you as the Q2 season progresses. Sure. In the meantime, don't forget, Shiraz written commentaries, earnings preview on Mondays, earnings outlook on Thursdays. On the homepage of Zacks.com, you can link to it from there. You can also link to it from the earnings page of Zacks.com. With Shiraz, I'm Terry Ruffalo.